Hey guys, I wanted to do up a video today to talk about something that we all conceptually understand but we don't always consider or we don't always apply when we're thinking about our investments, and that is that everyone's always selling something. So we're all selling something, whether that's our capital, whether that's our labor, whether that's information or entertainment or whatever you're selling. And so as a result, that often gives us incentives to do things a certain way or suggest things that are to our benefit or to someone else's benefit that may not necessarily be good information to use when making an investment. The next thing to consider is that not everything being sold is of equal value, and this is especially true of information. And we will all look for information to allow us to make good decisions when selecting those properties, bonds, stocks, or whatever investment. But it's our job as investors to realize that not all information is created equal, and we need to choose which information we're going to listen to and act on. Understanding that there are conflicts of interest in the market or people with agendas is important to working out which information you should and shouldn't listen to. You can't expect someone who's selling you something to give you the full story or give you all the negative sides of an investment or a decision or a bit of information if it doesn't serve their agenda. So it's your job to find that information that they may be withholding. In addition to that, when it comes to selling you on an investment or on a product or an idea, most people are going to tell you what you want to hear, and that's because it makes the sales process easier, and it's very difficult to convince someone of something that they just don't want to believe. In the world of investing and in finance, a lot of the people that we interact with in these markets may not have the incentive to look out for your best interests to the degree that a lot of us might hope. For example, a banker who you might go to borrow money from is mostly interested in lending you money because they make interest out of those loans. So they're happy to lend you money if they believe that you can pay that money back along with the interest. They're not as concerned about whether the money that you're borrowing is being put towards a good investment. They're just mostly concerned about whether they're going to get their money back. So they might be very willing to lend you money if they can secure it against existing assets or against an income that you have outside of this investment. They may not be as worried about if you lose lots of money on that investment. The same might apply if you're dealing with real estate agents, either as a buyer or a seller. A real estate agent gets paid when sales are made, so when they can find a buyer for a seller or find a seller for a buyer. And as such, they get paid their commissions when these two parties meet in the middle. So they have a large incentive to want the seller to drop their price and a buyer to lift, or hopefully lift, their price. And so if you were selling a property, you might find that even though you're employing a real estate agent to sell that property, they may spend a lot of time trying to sell you on bringing your price down to make it easier for them to sell the place and make their commission. And on the flip side, as a buyer, if you're walking through a home that a real estate agent is presenting, they're going to be selling you a lot on all the positives of that property. They're not going to be telling you about all the negatives or maybe the work that needs to be done or the problem neighbors next door or all the things that could be wrong with that property. The same would apply to stockbrokers. A lot of stockbrokers get paid when you make your trades, so they have an incentive for you to want to trade your stocks, like buy and sell shares. They are less concerned about whether the shares you're buying and selling are good investments. And if anything, they would rather you not be a buy and hold investor anyway. They would rather you trade. The same would apply to a fund manager. They're looking for you to invest as much of your money as possible into a fund because they make commissions on the amount of assets they have under management. So they're going to suggest that you allocate a larger proportion of your portfolio to something like stocks because that's what gets them paid the most, and it's also probably what they believe in the most, and they'll sell you on how good stocks are as an investment. In addition to that, a lot of funds will have performance bonuses where they incentivize fund managers to outperform the market. But incentives like that may have fund managers taking on more risk than what would be normal because they get paid to beat the market. So therefore, they may be looking to be a little bit more aggressive in their investments. And on the downside, they don't have as much downside risk because they're investing with your money. And even with investment research or stock analyst reports, many of those can have subtle conflicts of interest in that the stock analysts maybe working for firms that offer financial services to companies like capital raisings or trading of their stock or market making. So as a result, stock analysts might have a lot of pressure from their firms internally to be positive about that company, because to be negative about that company might upset the management of that company, and as a result they maybe find it more difficult to retain that company as a client. So there can be subtle conflicts of interest in the industry like that as well. So when you're looking to analyze a company, be sure you have your own thesis and look to things like stock analysis reports as secondary information, not primary information. Even media itself is primarily focused on advertising sales because that's how they make their money. So they have an incentive to try and want to engage as many people as possible. So for them, it's not about being as informative as possible as much as it is getting as many eyeballs watching their programs as possible. And given that advertising sales are their primary source of revenue, that can influence the content of their programs. So I would take a lot of information that you get from mass media with a grain of salt. This would apply to television or newspapers or magazines or even the internet. So just be aware that you want to understand how the person who is delivering you information is making money. The same would apply to any business owner that you're dealing with, or a startup founder, is that they all truly believe in their companies and they have a large incentive to promote how amazing their company is or how amazing their company will be. They're not always out there to tell you about the downsides of being in that industry or the risks or the potential capital loss. That, again, is your job to find out. You will even see the same thing with annual reports of companies where management will often try and paint a glowing picture of the company situation given the circumstances. Management often has an incentive to both have the share price go up because they have stock bonuses usually, and in addition to that, they're in the business of being employed by that company, so they want to always be seen as doing a good job or seen as doing a good job under the circumstances, because as a shareholder you vote for them to be re-employed every year. So that is often comes through in a lot of their reports and their shareholder letters. So you want to be looking at the factual data more so than you want to be reading the positivity of reports that come from management. And unfortunately, even in the financial advising industry, there can often be a lot of conflicts of interest and a lot of products that get pushed on retail investors or consumers that may not always be in their best interest, whether that's high fee managed funds or mutual funds or unnecessary insurance products and these things that may not be in the best interest of the client, but the advisor, especially if they're offering advice for free, may be making their money from the commissions from selling those products. So there's a lot of conflicts of interest out there, there's a lot of agendas, there's a lot of misinformation. And to be a successful investor, it's your job to be able to cut through all that to try and find what's real and what is actionable information. So when you approach investing, you want to approach it with a bit of a skeptical mind. You don't take everything to be true, take everything with a bit of a grain of salt. You want to be open-minded at the same time, and you want to look for the other side of the story, or look to see who's on the other side of the trade, because there's always a buyer and seller. And maybe one of the most difficult things to do is approach investing with a willingness to be wrong, or a willingness not to be right all the time, and a willingness to change your point of view when new information is made available to you. I think one of the best things you can do as an investor is to naturally seek the other side of the story. So if you were thinking about investing in a company on the stock exchange, you might go review some stock analyst reports, do your own research, but you also might go read the report of a short selling fund that might be short that company at the moment. A short seller is someone who makes money when a stock price goes down. So they have an incentive to look at companies in a different way. They're looking for companies that they think will go down in value. So if you go read the report of a short seller on a company, they may have lots of reasons why they think that company is a bad investment. So when you can compare why you think it's a good investment with a report on why it's a bad investment, it can give you that both sides of the story that allows you to make a more confident decision about that company. If you were looking to invest in a property, you might want to go speak to multiple real estate agents and look at a couple different properties, and also ask one real estate agent of what they think of another property being sold by another real estate agent, they might be willing to tell you all the negatives of that other property because they have an incentive to try and sell you their property. So you're looking to find people that have an incentive to go against someone else who's selling you their agenda. So that's how you can sometimes get around conflicts of interest. When it's difficult to get the other side of the story, something you can often do is look at what the people selling you something are doing themselves, in the sense that if a property developer is building a bunch of investment properties but they're selling them all off, you might want to ask them why they aren't holding onto them themselves if they're such great investment properties. Alternatively, you might have a management team that really rave about a stock or a company, but if they don't participate in the capital raising of that company themselves, you might wonder about how much conviction they really have about how good that company is and what the prospect of that company is if they're not willing to put their own money at risk. So there's a lot of information in the market, and it's your job as an investor to try and find out which information you should be listening to and acting on and investing with. Well, that's it for this video. Thanks for watching. Remember to like, subscribe, and share this video with your family and friends. See you in the next video.